Welcome to The Explainer. Today, we're going to peek behind the curtain of the corporate world. We're going to figure out what a company really owns and how the way they account for all that stuff tells a secret story about their strategy.
It seems like a simple question, right? What is a company really worth? But the answer is way more complicated than you'd think. How do you actually put a price tag on a massive global corporation? Turns out, it's not about the cash they've got on hand.
Yeah, the real long-term story of a company's value isn't in its checking account. It's hidden in things like its investments, its buildings, its machinery, what accountants call its long-term assets.
And that, right there, brings us to the central puzzle. Because accounting for these things is super tricky. I mean, how do you value an investment in another company when you don't actually control it? Or what about a bond whose price is bouncing around every single day?
All right, let's start with the first piece of that puzzle, equity. This is what we're talking about when a company buys stock, an ownership stake in another company. When it comes to accounting for these kinds of investments, all the complicated rules really boil down to one single powerful idea: influence. How much sway does the investor company have over the company it just bought a piece of? See, it's kind of like a sliding scale. If you own just a tiny sliver, you have basically no influence. But as that ownership percentage climbs, your presumed influence grows from what they call significant all the way to full-blown control. And here's the kicker. With each step up, the accounting rules change completely.
Okay, so for those smaller investments, we're talking generally less than 20% ownership, where a company has little to no real power. We use something called fair value measurement. The idea is actually pretty simple. The investment gets recorded on the books at whatever its current market price is. You just look it up.
So here are the nuts and bolts. At the end of every quarter, the company has to adjust that investment's value to match the market. And this is huge. Any change, whether it's a gain or loss, goes straight to the company's income statement. It directly impacts their profit. Oh, and any dividends they get, that's just treated as regular old income.
Let's make this real with a quick example. Abby Co. invests in Gale Co. Now, don't worry about the exact numbers here. Just watch what happens. In the first year, the stock price drops, so Abby has to report a $2,000 unrealized loss on its income statement. Ouch. But the next year, the price bounces back, and boom, Abby gets to record a $5,000 gain. It just shows you how the mood swings of the stock market can directly swing a company's reported profits.
But what happens when that ownership stake gets bigger? Let's say somewhere between 20 and 50%. Now, the company is considered to have significant influence, and the whole accounting game changes. We switch to the equity method. And the mindset is totally different. You're not just a passive observer anymore. You're treated more like a partner, sharing in the other company's success.
And here's where it gets really interesting. If the company you invested in makes a profit, your investment account on your own books goes up. But, and this is the big one, if they pay you a dividend, your investment account goes down. And that last point is absolutely crucial. Dividends are not income here. They're treated as the company just giving you some of your original investment back.
This example shows it perfectly. When company XYZ reports income, watch company P's investment count grow. They're basically saying, hey, our piece of XYZ is now worth more. But then XYZ pays out a dividend, and that investment account shrinks right back down because that cash has flowed from their investment back into their own pocket.
So let's put them side by side because this is where it all clicks. With the fair value method, you're riding the roller coaster of the market. Your income statement can look amazing one quarter and terrible the next. But with the equity method, the value is tied to the actual performance of the company you invested in. It gives a much more stable and arguably more meaningful picture of that investment's value.
Okay, so that's what happens when you own a piece of a company. But what if you're not an owner at all? What if you're just lending them money, say, by buying their bonds? This brings us to our next category, debt investments.
And here, the main principle does a complete 180. For debt, we don't care about influence at all. The only thing that matters is your intent. What does your company plan to do with that bond?
Accountants have sorted this into three main buckets. First, held to maturity. This is exactly what it sounds like. You plan to just sit on that bond and collect your interest payments until it's paid back. Then you've got trading, which is for the fast movers who are trying to buy and sell for a quick profit. And finally, there's available for sale, which is basically the catch-all category for everything in between.
Now check out this example from Maverick Co. They bought this investment with the plan to trade it. And wait a minute, does this look familiar? It should. The accounting is basically the same as the fair value method we saw earlier. You update the value to match the market price, and in this case, the $1,000 loss goes right onto the income statement. We've covered the financial paper, stocks and bonds. Now let's get our hands dirty and talk about the heavy stuff, the most physical category of all, property, plant, and equipment. We're talking the factories, the trucks, the computers, all the tangible things a company uses to actually run its business.
For all these physical assets, the core rule is beautifully simple. You start with what you originally paid for it, period. This is what's known as historical cost.
So, the value of that asset on the balance sheet, what we call its carrying amount, is calculated in 3 steps. You take that historical cost, what you first paid. Then you subtract all the depreciation that's been recorded over the years to account for its wear and tear. And finally, if something major happens and the asset permanently loses a chunk of its value, you subtract that too. That's called an impairment loss.
So, we've got all these different rules for equity, for debt, for physical stuff, but this isn't just a boring accounting exercise. The reason any of this matters is because the choices a company makes in its accounting can reveal a huge amount about its real-world strategy.
Think about it. When you see a company using the fair value method a lot, you know its earnings are exposed to the daily whims of the stock market. See the equity method? That's a big flashing sign that they have a deep strategic partnership with another firm. And how they classify their bonds? That tells you everything about whether they're playing a short-term trading game or a long-term cash management game.
At the end of the day, these aren't just technical, arcane rules for accountants. They are the language companies use to communicate their financial health, their strategies, and their entire story to the world.
So the next time you look at a company's financial statement, don't just see the numbers. Ask yourself, since they have choices in how they account for what they own, what is the story their choice is telling me about their real strategy?